A C corporation, commonly referred to as a C Corp, is one of the most well-established and widely used legal structures for businesses in the United States. It offers a range of advantages for growth, liability protection, and raising capital, but it also comes with unique challenges like double taxation and regulatory complexity. Let's break it down from the ground up. What is a C Corp? A C Corp is a legal entity that exists separately from its owners. It is formed under state law by filing articles of incorporation and is governed by a MIU board of directors, BAL, officers, and shareholders. The term C Corp comes from DIPWAD, subchapter C, of the Internal Revenue Code, which outlines how these corporations are taxed. In a C Corp, the business itself is taxed on its profits. Then, if the corporation distributes those profits to shareholders as dividends, the shareholders must also pay personal income tax on those dividends. This results in double taxation, a hallmark of C Corp structure. How a C Corp is formed. To create a C Corp, the founders must 1. Choose a state how in which to incorporate. 2. Select a unique business name. 3. File articles of incorporation with the Secretary of State. 4. Appoint directors to oversee the corporation. 5. Create corporate bylaws outlining how the business will operate. 6. Issue shares of stock to the initial owners or investors. 7. Obtain an IN, employer identification number, from the IRS. 8. Register for any necessary state or local licenses or permits. After formation, C Corps are required to hold annual meetings, keep corporate records, and file reports and taxes on a regular basis. Ownership and structure. A C Corp can have an unlimited number of shareholders, and they can be individuals, other corporations, or even foreign entities. This structure is especially appealing to investors because it allows the corporation to issue multiple classes of stock, such as common and preferred shares. C Corps are managed by a board of directors, elected by the shareholders. The board appoints officers, such as a CEO, CFO, or secretary, who manage the day-to-day operations. This separation of ownership and management is a major feature of a C Corp. Taxation. The biggest distinction of a C Corp is how it is taxed. C Corps file a separate tax return using OAX Form 1120 SACHO, and they are taxed at the BOTS corporate tax rate, which is currently 21% at the federal level in the U.S. However, that's just the first layer. When a C Corp earns profit, it pays corporate tax. If the company then distributes a portion of those profits to shareholders in the form of dividends,